In 1397 in Florence, Italy, a cautious and disciplined man named Giovanni di Bicci de' Medici opened a bank. Not the first bank in history, not the only bank in Europe. Florence already had a thriving financial culture. Other banking families had come before him, some of them had become enormously powerful. And then they had collapsed catastrophically, completely, and instructively, in ways that Giovanni studied carefully before he ever opened his doors. What Giovanni built was not banking from nothing. What he built was something arguably more important. He built a system, a set of structures, disciplines, and financial tools that organized how banking worked across an entire continent. And those structures, the branch network, the bill of exchange, the holding company, the separation of risk, the relationship between private finance and state power, did not stay in 15th century Florence. They traveled forward through 500 years of financial history and arrived, largely intact, in the bank you use today. This is not a story about the Medici family becoming famous. It is a story about how one banking institution built the architectural blueprint that modern finance still runs on. And buried inside that blueprint are a set of structural decisions, some brilliant, some deliberately self-serving, that were made 600 years ago and have never fundamentally changed. By the time this video ends, you will understand not just what the Medici Bank was, but why the way your bank operates today, the way credit moves across borders, the way financial institutions manage risk by separating it into branches, and the way money and political power have always been inseparable. All of it traces a direct line back to a counting house in Florence in 1397. Let us start with the world Giovanni walked into. Because the most important thing about the Medici Bank's founding is not what Giovanni built, it is what he learned from watching other people fail. The Bardi and Peruzzi families were the dominant banking powers of 14th century Florence before the Medici. They were enormous. They operated across Europe. They were trusted by kings and popes alike. And in the 1340s, they were destroyed almost overnight when King Edward III of England defaulted on the massive loans they had extended to fund his wars. The Bardi and Peruzzi had made the most fundamental mistake in banking. They had concentrated too much of their exposure in a single powerful borrower who had no legal obligation to repay them and every political reason not to. Giovanni di Bicci de' Medici watched this lesson play out from a distance and understood it completely. When he built the Medici Bank in 1397, his first structural decision was the one that would define everything that followed. He would not build one centralized bank. He would build a network of semi-independent branches, each operating as a separate legal entity, each carrying its own risk, and none of them able to bring down the others through a single catastrophic failure. This is called risk compartmentalization, and it is the foundational structural principle of every major modern financial institution on Earth. J.P. Morgan Chase does not operate as one entity. It operates as hundreds of legally separate subsidiaries, each ring-fenced from the others so that a failure in one division cannot automatically collapse the whole. Goldman Sachs, Bank of America, HSBC, every major bank in the world today uses a version of the exact same structure that Giovanni di Bicci de' Medici built in Florence in 1397 after watching the Bardi and Peruzzi learn the hard way what happens when you don't. But the branch network was only the first innovation. The second was the one that truly changed how money moved across the world, and it was called the Bill of Exchange. Here is the problem the Medici Bank solved. In the 15th century, physically moving gold and silver across Europe was dangerous, expensive, and slow. Merchants who needed to pay suppliers in another city had to either transport the metal themselves, risking robbery and loss, or find some other mechanism to transfer value without the metal physically moving. The Bill of Exchange was that mechanism. A merchant in Florence who needed to pay a supplier in London would go to the Medici branch in Florence and deposit the local currency. The Medici branch would issue him a written document, the Bill of Exchange, which he would send to London. The supplier in London would present that bill to the Medici branch in London and receive payment in local English currency. No gold had physically moved. Value had transferred across an entire continent through paper and trust. If that sounds familiar, it is because you use a direct descendant of this system every single time you make an international bank transfer, use a credit card abroad, or send money across borders through any modern financial institution. The fundamental mechanism, depositing value in one place, receiving equivalent value in another place without physical transfer of money, is the same mechanism Giovanni's branch network was built to enable in the 1400s. But here is the part that made the Bill of Exchange not just convenient but also enormously profitable. The Catholic Church in the 15th century officially prohibited usury, the charging of interest on loans. Lending money for profit was theologically forbidden. And yet the entire economy of medieval Europe depended on credit. People needed to borrow. Merchants needed capital. Governments needed loans. The bill of exchange was the solution to this problem. Because bills of exchange operated across different currencies, the profit built into the exchange rate, the difference between what you deposited in Florence and what was paid out in London, was technically currency exchange, not interest. It was a fee for a service, not a profit on a loan. And the church accepted this distinction, which meant the Medici Bank could charge what was effectively interest on financial services while remaining in full compliance with church law and in full favor with the papacy that was one of their most important clients. This is called regulatory arbitrage, finding the gap between what the law prohibits and what it permits and building your profit model inside that gap. And it remains one of the most powerful tools in modern finance. The financial products that generated billions in profit before the 2008 crisis, mortgage-backed securities, credit default swaps, structured investment vehicles, were all designed by people who studied the regulations carefully and built their products in the space between what was explicitly forbidden and what was technically allowed. The Medici did not invent regulatory arbitrage, but they perfected it in a form that every major financial institution has studied since. Now let us talk about the relationship that made the Medici Bank the most powerful financial institution in 15th century Europe. Because no discussion of the Medici blueprint is complete without discussing what earned them the extraordinary nickname that contemporaries gave them. They were called God's bankers. The Medici Bank became the primary financial institution managing papal revenues across Europe. The Catholic Church collected fees, tithes, and payments from parishes, bishops, and monarchs across the entire continent. All of that money needed to be collected, transferred, converted between currencies, and delivered to Rome. The Medici branch network was the infrastructure that made this possible. In return, the relationship gave the Medici something more valuable than the management fees they charged. It gave them prestige, political protection, and access to the most powerful institution in medieval Europe. No king or prince would move against a family that managed the Pope's money. No competitor could match the credibility that came from being trusted with the church's finances. This relationship between private banking and powerful political institutions is not ancient history. Today, the largest banks in the United States are designated as systemically important financial institutions, a legal status that means the government considers them too interconnected to the financial system to be allowed to fail. That designation gives them lower borrowing costs, implicit government backing, and a level of political protection that smaller competitors cannot access. The specific mechanism is different. The underlying dynamic, private finance and state power protecting each other because each needs what the other provides, is identical to what the Medici built with the papacy 6 centuries ago. But now we need to talk about what destroyed the Medici Bank. Because the story of its collapse is as instructive as the story of its rise. And the reason it collapsed reveals something deeply uncomfortable about every financial institution that has followed in its footsteps. The Medici Bank did not fall because of external enemies. It did not fall because of a single catastrophic loan default the way the Bardi and Peruzzi had. It fell because the family that owned it gradually stopped prioritizing banking discipline and started prioritizing political power, cultural prestige, and personal ambition. Lorenzo de' Medici, known to history as Lorenzo the Magnificent, was a brilliant political leader, a generous patron of Renaissance art, and a genuinely remarkable human being. He was also a poor banker. Under Lorenzo's leadership, the bank's branches became less rigorously managed. Political relationships began taking priority over credit discipline. Loans were extended to clients whose value was political rather than financial. Resources that should have been reinvested in the business were redirected toward art patronage, political alliances, and the kind of civic prestige that made the Medici name legendary but made the Medici Bank fragile. In 1494, the political crisis in Florence ended Medici power in the city. The bank collapsed with it. An institution that had operated for nearly a century, that had built the financial infrastructure of Renaissance Europe, that had pioneered the structural tools that modern banking still uses, gone within a generation, because the people who inherited it chose influence over discipline. And here is the uncomfortable final parallel that brings this story to 2026. The same thing that made the Medici Bank powerful, the blending of money, political connection, and institutional influence, was also what made it ultimately fragile. Because a bank that depends on political relationships for its protection is only as stable as those relationships. And a financial system built around the alignment of private profit and political power will always eventually find that alignment breaking down in ways that ordinary depositors and ordinary citizens pay for. The 2008 financial crisis, the savings and loan crisis of the 1980s, the collapse of long-term capital management in 1998. Each of these was a version of the same story. Financial institutions that had grown powerful through a combination of genuine innovation, regulatory navigation, and political connection eventually discovered that the same connections that protected them on the way up could not fully protect them when the underlying discipline had eroded. The Medici built the blueprint. Every bank since has used it. The branch network, the bill of exchange, the holding company structure, the relationship between private finance and state power. The use of regulatory gaps as profit opportunities. All of it is still here. All of it is still operating. And the structural fragility that brought down the Medici Bank, the tendency of financial institutions to blend profit with political influence until the two become indistinguishable, is still here too. Giovanni di Bicci de' Medici opened a counting house in Florence in 1397 with a simple philosophy. Be cautious, diversify your risk, do not overexpose yourself to any single powerful borrower, maintain discipline above prestige. The bank he built lasted nearly a century and shaped 500 years of financial history. The banks that came after him used his blueprint but quietly discarded his philosophy. The vault has been open since 1397. The question is whether anyone was meant to notice what was built inside it.